Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A episode. And the first question is from Manny. Bit of a long email. There's a lot going on here, but let me see if I can summarize it. Manny's 43, wife is 35. He earns 200, she earns 90. Kids are 5 and 6. They currently go to public school, but they want to send them to private school beginning in 7 years' time. It'll cost around $25,000 a year. It'll cost more than $25,000 a year, by the way, of course, in 7 years' time. And by the way, when we do financial projections, we assume that fees will increase by about 5% per year. So that puts the cost in 7 years' time about $32,000. So plus there's probably a few on costs there as well. Anyway, they'd like to retire at age 60, or when he turns 60, so 17 years, on 250,000 of income. They felt like they were on track, but they feel like it might be a bit of a struggle because they want to bulldoze and rebuild their family home. So I'll just give you a bit of a rundown. We've got 5 investment properties outside super in personal names. Total value is 6.7 with about 3.1 worth of debt. So net equity about 3.5. We've got about $1.5 million of debt on the family home worth 2.4. They were rent vesting and they've just got into the market. Well, I say just got into the market. Yeah, okay. I don't know when they purchased. It could have been 2010, but they're rent vesting for a while. And they've got another investment property inside super. Total super is about 580. He's 43, she's 35. That's not too bad. I think that's not too bad in terms of balances. And the question really is, well, the complicating factor is that Manny thinks he'll get a redundancy soon, and given his job is quite high stress, when he finds if that happens and he wants to find a replacement job, he wants something that's a little bit lower stress. He's asked me not to mention the employer, but I should say that I've got a client that is in the same industry, and it's always funny, isn't it, when you see people on high incomes? There's that saying that there's a cost for everything. Sometimes you see people on very high incomes, you think, gee, they're doing well, but there's no such thing as a free lunch. There's always something to pay. There's always a price to pay, whether it's stress or time with family or whatever it is. Anyway, it's just an interesting observation. And I guess, from a financial planning perspective, we can always put it in that context as well. And in terms of the decisions we make in our life, sometimes we get, there's some shiny objects and we think, let's go in that direction. But really the best thing to ask is, what is the cost? There's always going to be a cost. What am I foregoing? I'm getting something, but what am I foregoing? Anyway, I'll get off my soapbox and continue on with Manny's situation. So they'd like to bulldoze and rebuild in around about 2030, so about 4-ish years' time, and that's going to cost $1 million. Remember, they've already got $1.5 million of debt. The challenge is going to be they've already got more debt than what they can probably service today. When I say service, I mean from a borrowing capacity perspective, so from a technical perspective. The property portfolio, Manny says, is relatively neutral. So really from a cash flow perspective, they're just servicing the home loan. So the question really is, how does all fit together? How do we pay for $1 million rebuild, repay the home loan, and retire in 17 years' time? And Manny's made the observation, I don't want to sell any investment properties. Well, of course, because he wants the compounding capital growth. But I don't think I can qualify for the required amount of borrowings. Well, that'd be true. Is there any other way of doing it? Well, there's no other way of doing it unless Manny, you're aware of some sort of way to magically create money. I'm saying that facetiously, of course. But sequencing here is, and it always is, it's, on the face of it, we see this as maybe a borrowing and repayment question, but really it's a sequencing question in terms of what order do I do these things in, and if I do them in a certain order, what are the opportunity costs and risks that I need to think about? Look, I've thought about it for a while. I'm not sure if I have any magical solutions here for Manny. I think it's really just about, firstly, if you don't want to construct for 4 years, a lot can change over a 4-year time period, including your own desires and goals, and also then your employment situation, and also borrowing capacity, and also property growth. So I think, firstly, I wouldn't make any specific decisions at this point. The key element here, from my perspective, is that that Manny's very highly leveraged for his income, and he'll be very, very highly leveraged for his future expected income. And when that happens, we need to make an adjustment. So just because you made a decision, 5 years ago on a certain, when your situation, your financial situation was X, if X becomes Y, we need to go back and revisit that situation. It's not just a case of, well, we made that decision, it is what it is, and now we've got to find some way to navigate it. Ultimately, we need to revisit fundamentals and be rational about our decision making. So if that means that, okay, we're going to have a job change, we're going to have an income change, we need to adjust our strategy to accommodate that income change. It might mean that you need to change your goals. So, for example, instead of doing the rebuild in 2030, make it 2035. And the reason you've got to push it back 5 years is because you've taken a haircut in your income. The alternate is, well, we can't hold, I actually said 5 assets outside of super, it's 4, so apologies for that. So 4 outside super, 1 inside super, so we've got 5 investment properties in total. Well, someone on that revised income's not going to be able to service 5 investment properties. You might say, look, I'd love to hang on to them, and I get that, but you can only do what you can do, and you've got to make safe decisions, safe and prudent decisions. I think it looks like Manny's done a couple of subdivisions. So he's got 2 properties in the same street, in the same suburb, side by side. So they're duplexes, I'm assuming. So that's 4 properties in the same location. And there's a lot of equity in those properties. Arguably, those properties are now, the improvements on those properties make up a substantial part of the value. I'm going to assume, I'm not saying that's the case, but that'd be the question. So, it doesn't make sense necessarily to have so much concentration. If you have to reduce debt, which you do, you're kind of in the situation where your situation's changed, so you really should reduce debt, then it's really divesting of property. So there's no magic answer here, but I guess it's what is more important, your goal to rebuild your home or your goal not to sell any investment properties, because one of them is going to have to move. And I would argue that it's sell an investment property just because your debt exposure is just too high. Now, you might tell me it's okay, Stuart, they're washing their own face, like they're not costing me any money. But there's other factors that we need to consider that are going to be related to how much debt we have. So, for example, being able to refinance, or, if you're locked out of the refinance market because you've got way too much borrowings and your income can support from a lender's capacity perspective, then, you are beholden to, whatever your lender does. And Manny did mention he's with Latrobe, so he's already probably paying a higher interest rate. Notwithstanding that, what happens if there's, something goes wrong with the property or there's some vacancy for a period of time? It's not prudent to continue to hold a lot more debt than what you can manage, particularly if you don't have enough liquidity. I should say Manny hasn't told me whether he's got a lot of money in offset accounts. I suspect the answer is no, but, that in the absence of having that sort of buffer in place, you probably, if you were my client, I think my inclination would be I'd be leaning towards reducing debt. Now, you don't necessarily need to go out and do that tomorrow. You want to be strategic about it. But I think it's about making friends with the fact that if you want to make a couple of lifestyle decisions, such as earn less income than you're earning today and rebuild your family home, that there's a cost. There's always a cost associated with that decision, and there's a compromise to make, and you might have to divest of some of those property assets. I should say one thing I didn't mention was that Manny said he's about 200,000 of employee shares, so the current employee he works with. I've said this a number of times, and I think Campbell has too on the podcast, that typically we tend to divest of employee shares when they vest. So when we're able to sell them, we typically sell them. And not only just because we've got to pay for the tax associated with those employee shares, but also just to reduce the concentration risk. We're already earning income from that employer and that industry. We don't want to end up holding a lot of wealth in that industry. And, if we don't necessarily have a perfect crystal ball on where the share price is going to go, well, then gradually divesting of them when they vest makes a bit of sense from our perspective. So good luck with it all, Manny. I'm sorry I can't give you some magic answer, but hopefully that commentary helps you kind of understand kind of how to navigate the inevitable changes in life and inevitable changes in goals as well. Okay, next question is from Anna, and it's got two questions. We're planning retirement and expect to have a decent amount in tax-free superannuation pension phase. We'll also have some taxable income from dividends, bank interest, and a small defined benefit pension. We will likely continue to make concessional contributions when retired. My question is, how do we calculate the optimal amount of concessional contributions to best offset tax liabilities, which might happen from year to year? Specifically, is there a program or online calculator or just a formula that could help? Okay, so great question. When you're in retirement, should you make concessional contributions? Now, of course, that tends to be a tax-based decision. So, and you need to look at the marginal tax rates. So you can earn 18,200 up to 18,200, or really with the low income earners offset almost about 20,000 and not pay too much tax. So if your taxable income was less than $20,000 each in terms of each spouse, then you wouldn't make any super contributions. Now, between 20,000 and 45, just roughly, you're going to pay 18% tax. If you made a super contribution, you can claim a tax deduction, but you're going to be taxed. The contribution tax rate is 15%. So you're going to save about 3% between 20 and 45,000, just roughly. I'm not sure that's really worthwhile. It just depends on what sort of numbers we're talking about. And probably the main attraction for making concessional contributions is just moving more wealth into super. And if you haven't fully utilized your transfer balance cap, which is the amount each individual can have in pension phase, then you might do that. You might do that because you want to put more money into super, not necessarily because you want a tax benefit. But if your taxable income exceeds 45,000, then you'll be taxed at 32%, including the Medicare levy, in which case then making super contributions is far more economical because that's at 15. So it's half the tax rate. So if I had a client with, say, $65,000 taxable income and was retired, and that taxable income was from dividends and imputation credits, all those sorts of things, then I'd probably make at least a $20,000 concessional contribution to bring their taxable income down to 45. So into that 18% tax bracket or below that $45,000 benchmark. So that's the way to look at it. The challenge is you're going to have to try and estimate what your taxable income looks like in June of each year. And you want to get those contributions in well before 30 June. So don't leave it too late, because they actually have to be credited to your account for you to be able to claim a tax deduction. And all super funds will have cut-off deadlines in that regard. So probably early June, it's about sitting down and working out what your taxable income looks like and then making those contributions well and truly before 30 June to bring your taxable income down to 45,000 or lower. Okay, next question from Anna. Second part of the question. The first question is good, but the second part, I think, a little bit better. A bit more exciting from my perspective. My second question is a bit more philosophical. In the Q&A episode on the 25th of November 2025, you addressed a question from someone who had $8.5 million investable assets. You commented that because they are in such a strong position, they could afford to take a little bit more risk. That really gave me pause for thought. My approach had been to still maintain some exposure to long-term growth assets, but to reduce the weighting as we approach retirement, with the theory that now that we don't need to take as much risk in order to reach our goals. Is this the right answer, or is this just about individual tolerances for volatility? It is a really good philosophical question. Yes, certainly it's a little bit about risk tolerance, but I also think risk tolerance is about education. So sometimes we make assumptions around what is risky, but then when we sort of understand risk better, I think, then, that reframes our risk tolerance. So for example, underinvesting, so that is having been too conservative, certainly earlier in your life is risky, right? Because if you're underinvested in growth assets, if you're too defensive, you're almost certainly over the long run going to produce a lower investment return. And as a result of producing a lower investment return for many years, you're putting your goals at risk. So being risk adverse too early is actually more risky. That's kind of the way I'd frame it. For someone that has a lot of assets, a lot of surplus assets, the way I would look at it is that I would say, what portion of that portfolio do I want risk-free that I'm not going to worry about? And, that might be equal to somewhere between 1 and 3 years worth of living expenses. So if you're spending 150 grand a year, it's between 150 and $450,000, I would think, right? Just as a rough, it's going to be different for different people, but what it was going to make you happy. And then you could say, well, the rest of the portfolio can go all growth. And because you're able to at least have 3 years of living expenses in defensive assets, then you don't need to really worry about volatility. Chances are there's going to be something to sell in the first 3 years of that volatility event. And I should say that if we're employing an approach that seeks to mitigate portfolio risk by directing capital into parts of the market that are attractively priced, then I would argue that not everything's going to be smashed. Like if the market crashes, of course, everything crashes with it. But those parts of the market that were already, let's say, undervalued will most likely recover faster. And we've seen this in the last few weeks with the Iranian war, where you can see some of those sectors of the market that were already cheap, haven't fallen as much by the ones that were more expensive. And that's what you would tend to see. So the interesting thing is that, within a year, almost of any market cycle, there's always going to be something to sell. And you'd be selling that part of your portfolio. I mean, you wouldn't be particularly unhappy about selling that part of the portfolio. So sometimes we overstate, how much capacity we have to deal with volatility. And I think volatility is really just about understanding if this happens, what happens to our portfolio and what is our reaction? And are we comfortable with that? As long-term investors in growth assets, we have to expect large volatility events. We've got to expect a lot of intra-year volatility. The intra-year volatility, I think Campbell mentioned this in a podcast recently, is something like, I can't remember the numbers, like 12 or 14%. That is, you can be 12 or 14% down during the year, even in a positive overall year. So it's just normal. And we just got to make friends with that. And so I would say that, if you've got the capacity to withstand volatility, if you've got an $8.5 million portfolio and the market crashes and you have 6 million, well, you're still okay, right? You're not probably going to worry. I mean, it'd be sad to lose $2.5 million of value, of course, but you're not going to lose any sleep. I wouldn't have thought. And that's what I was sort of arguing for, that, look, you've got capacity then to take risk. Volatility doesn't really matter in that situation. But it all comes back to, I've got clients that have surplus assets and they've got quite a conservative, maybe only 40% in growth assets. So it's not a one size fits all. But then I've got actually other clients that they've got surplus assets, and their goal is to, because they were lucky enough to inherit a lot of their money or some of their money, they want to sort of continue to pass that on through future generations. So they want that portfolio to still continue to work hard. So in their situation, we're talking about increasing their growth assets. Really just depends what you want to do. But I think the overarching comment is, I think risk profiling and risk assessment is sometimes a personal thing, and sometimes it's related to past experiences, all those sorts of things. So I'm not saying let's ignore it. But I think in many situations, it's an education exercise. At least that's how we see it as financial advisors, that we can design a portfolio that makes people feel comfortable, that allows them then to invest more in growth assets. And we know point to point over, decade-long periods, that's ultimately going to maximize returns, which I think maximizing returns reduces risk, because the chance of needing to run out of money, or in fact being surprised on the upside in terms of surplus money, is better than the reverse. But thanks heaps for your question, Anna. It's a really good one. And in fact, I've just finished writing a blog, and the title is How to Avoid Working Too Long and Underspending in Retirement. And the blog kind of interrelates to Anna's question in terms of, you've got a healthy phase of retirement, and then maybe the second phase is you've got less ability to do or spend money. And it's just about making sure that you don't really look back, maybe in your 80s, late 80s, 90s or whatever, and thinking, I should have done more in my 60s or 70s. And that blog is about that. And I think it's interrelated because it really is about asset selection. And also it's about dividing portfolios up just notionally from a capital perspective and treating that capital differently. So anyway, I'm going to talk about that in April. Okay, next question is from Luke. Luke's a farmer. A bit of an interesting question. I'm a farmer in New South Wales. I'm in negotiations with a solar company to put solar panels on my farm. The annual income, rental income, will be $700,000 a year net to me for 30 years indexed to inflation. We have the option of taking annual rent or the net present value of the cash flows, which would be circa $11 million lump sum as at least paid in advance. The farm is owned individually by my wife and I. My wife and I own the farm valued at $5 million with $1.5 million of debt. Principal place of residence is 1.2 with 400 of debt, 500 in super. My wife's a school teacher on a salary of 120,000. We're 43 years old with 2 teenage children. I'm thinking of transferring the farm into a family trust with a bucket company or a company with shares owned by the family trust to minimize income tax moving forward. What are your thoughts on these structures and taking a lump sum versus annual payment? The discount rate on the present value calculation is 7%. Okay, so just for those that are listening, net present value just expresses what the value of future cash flows are in today's dollars. The discount rate depends on what you want to reflect, but in this situation, the discount rate of 7% is what what the person, the company that's renting the land, what they assume the money is worth to them. 7%, they can earn 7% a year or pay in advance. So as long as Luke is confident he can earn 7% or more on the money, then he should take the annual payments. If he doesn't think he can earn 7% on the money, then he's better to take the net present value. Now, of course, we need to think about the taxation implications, that if he receives the $11 million, it's most likely to be taxed on revenue accounts. So that's a big tax bill in one particular year. And if he can move the farm into a structure that's going to be more beneficial, and I would say probably family trust with a corporate beneficiary might be the best way to go from that perspective. But you'd need to really think about, stamp duty, because you're going to have to pay stamp duty for the transfer. And also you got to think about, what's the value of the land, and will the ATO attack that value? Because if you're looking at this, if you've got this offer, then maybe the land's worth more than $5 million because it can be used as a solar farm. And especially if there's been solar farms around in the area, that you've got to deal with, or you've got to get some good tax advice, because the ATO is pretty aggressive and they'll try and attack something if they think there's some tax planning going on. So you've got to have a reason of why you change the ownership of the land before entering into this contract, other than to obtain a tax benefit. So if it's primary or predominantly to obtain a tax benefit, it'll fall within Part 4A. So you've got to be really, really careful with something like this, and cutting corners or trying to work out things yourself, you've got to be quite cautious with. So don't forget that if we take a lump sum, we might not be able to really change the ownership structure. And actually, if you then do change the ownership structure, I think you've got a greater risk with the ATO, because all of a sudden you've got a big tax bill. Either way, you've got a big tax bill in one particular year, which is not ideal, and they might then sort of audit it. So I think if you take it depends on what you do with the money, of course. But, if you're going to invest it wisely or use it to fund living expenses, of course, then, I think 7% discount rate is about right. And I think it's it's not line ball. You're probably better off taking that 30-year income stream, because it does reduce your risk in that you've got 30 years of living expenses there, irrespective of what market does. So you've eliminated some market risk there. And plus, I think if you invest wisely, the probability of achieving or exceeding 7%, not every year, of course, is pretty high. So I think it's, this is not advice, of course, it's information only, but I think it's probably take the annual installment, but get some very careful tax advice around changing ownership, because you're going to pay stamp duty and you don't then want the ATO to come back after the fact and unwind it on you. That's only just going to be, twice as much or doubling the cost for yourself. Good luck with it, Luke. Hope it all works out. It sounds like a great opportunity. Okay, next question is from LT. LT's got a question on debt recycling. He writes, he or she, I should say, writes, I wonder if you can clarify a question I have about debt recycling and claiming interest deductions. I came across debt recycling recently and I'm thinking about using it. I currently have a primary place of residence mortgage of a home loan about $1 million. If I debt recycle it and use the money to invest in ETFs, and after, let's say, 2 years, it's grown to 200,000, can I sell the 200,000 of ETFs and move the money into a family trust to invest and still claim interest on the $1 million? Then to offset the capital gains tax from the 200,000, I can salary sacrifice the equivalent into my superannuation. I'm an SA worker and there is a unique superannuation privileges where we have a lifetime concessional cap and I can salary sacrifice my whole salary if I choose. That's called an untaxed super fund for those people listening at home. All the figures are hypothetical. I just want to clarify the concepts from a tax accounting perspective. All right, I've got another episode coming up, also in early April, about lump sum share investing. I talk about debt recycling in that episode too. Debt recycling, let me try and explain debt recycling in very, very simple terms. If I have $10,000 in surplus cash flow. So, I've got an income, I'm paying for living expenses, I'm paying for my minimum mortgage repayments, home loan repayments, and then outside of that, I've got an extra $10,000 a year. So I'm really focused on repaying my home loan. So why don't I just put the $10,000 into the home loan? But also I want to build wealth, right? So what I'll do then is I'll put the $10,000 into the home loan. And let's say my home loan's 100,000, so it reduces to 90. And then what I'm going to do is draw a second loan and draw $10,000 out of that. That's an investment loan. And then I'm going to invest that in ETFs. So now I've got total debt of 100,000, so it hasn't really changed, except that my home loan is reduced to 90, and now I've got a new investment loan of 10. And I'll do the same thing in year 2. So my home loan reduces to 80, and my investment loan goes to 20. And if I keep doing that for the next 10 years, all of a sudden I've got no home loan and I've got an investment loan. That's debt recycling. Now, here's the thing. Here's the important thing to understand. This is the nuance, because sometimes people that sell, in inverted commas, this strategy online, particularly on social media, will sell it as a way of repaying your home loan faster. It does not. It almost never repays your home loan faster. Why? Because when I go and borrow $10,000 to invest in the share market, I'm going to have to pay some interest on that $10,000. Of course, right? No such thing as an interest-free loan. So let's say I pay 6.5% interest. It's going to cost me $650. But what income will I get off that $10,000? Well, if I put it into a global share index, maybe $200, $250. If I put it into, a diversified ETF, it's going to be even lower than that, potentially zero income. So anyway, I'm going to lose money. There's going to be a shortfall there, which I can negatively gear so I can offset that income loss against other income. But let's say I get $200 of income, $650 of interest expense. So from a taxation perspective, I've lost $450. Let's say I get a $200 tax deduction, and so I'm out of pocket $250. So actually, instead of having $10,000 to repay my home loan, I've now got $10,000 less that $250. So because debt recycling exposes me to more interest, albeit tax deductible interest, and depending on the proportions that I'm investing in, it doesn't help you repay your home loan faster. The only way it can help you repay your home loan faster is if the income that you get from those investments is more than the interest, in which case, after tax, you'll have some more after-tax dollars to put towards your home loan to accelerate the repayment. That's the only situation. I'm not saying that debt recycling is not the right strategy, but I just want to be really clear about it. Still a very powerful strategy. I'll talk about it at the beginning of April, so in a few weeks' time, a little bit more in terms of, how you sort of navigate it. But LT in his question's getting a bit confused. I think LT thinks that all of a sudden I can suddenly magically make $1 million disappear and then reborrow that $1 million and invest it in the share market. That's not how it works. I mean, if LT, for example, had $1 million home loan and $1 million in the offset account, yes, he could. He could put that $1 million, reduce the home loan, and then redraw it and do what he says he's going to do. But there's no way of magically making LT's $1 million home loan disappear. The only thing he can do is put all his cash cash flow, as much cash flow as possible towards repaying the home loan and then borrowing against the equity, the new equity that he now has in his home because he's repaid his home loan faster, to borrow to invest in the share market. If you're a member of an untaxed super fund where you don't have your standard untaxed super fund, just means that I can make contributions. I've got a lifetime concessional contribution cap and I don't pay contributions tax until I take the money out. So really I get to invest my money pre-tax. There's not many of them around these days and many of them have been closed. So they're a little bit rare. But in LT's situation, I mean, just really to answer LT's specific question, probably doesn't apply to many other people, but yes, you could. You could offset capital gains tax by making a lump sum contribution. But of course, then you've got to make the contribution, right? So you can't move the money into the trust, claim a paper contribution, still have that money in the family trust. So LT, I think you got yourself a little bit confused here and that's okay. But, maybe get some advice before, making any substantial financial decisions because you really need some clarity around these points about what's doable and how to do it. And just be careful about, listening to stuff online. Okay, next question is from B and M, really long one. So I think I'm going to leave that till tomorrow. Tomorrow, I'm going to share 10 case studies from the Melbourne property market that outperform the median, because I think there's a lot of reasons to be, and certainly the Melbourne market has been a really poor performer for, almost 15 years. So I'm not shying away from that. But what I wanted to do is, and it's a bit anecdotal, but not necessarily statistically reliable analysis. But what I want to do is pull out some sales, identify some sales of some properties that actually have done better than the median house value that have occurred over the last 15 years and see if I can draw some similarities between those sales. So that the idea is, what can we learn? So if we've invested in the Melbourne market, some investors have done okay over that time in terms of bought and sold and generated some good returns. How have they achieved that? Is there some commonality? Because we can take those lessons, hopefully into a market that is prime for a growth cycle, but just still make sure that we can learn, what has driven outperformance. I guess that's the key thing in the Melbourne property market. That's tomorrow, and I'll hopefully get some time to deal with some more questions tomorrow as well. So until then, take care. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.